look at BigBear.ai. If you follow the market at all, you definitely know the ticker, right? It's BBAI.
Oh, yeah. It's been everywhere.
Right. And you pull up the chart today, and I mean, it is just a bloodbath. It's slashing sell signals. It's locked in this brutal, months-long falling trend.
Yeah, it's heavy. Really heavy.
But then you turn around, you open up a financial portal or whatever, and some analysts out there are literally pounding the table. They're calling it a strong buy.
Which is wild, right?
It is. They're looking at the exact same company and claiming it is deeply undervalued.
Mm-hmm.
So, you have to ask yourself, is this a hidden gem just waiting for the broader market to wake up? Or is this the ultimate retail trap, like totally designed to empty the pockets of everyday investors?
I mean, it really is the defining puzzle for this specific stock right now. You rarely see two completely opposite narratives colliding in real time with this level of intensity.
Yeah, totally.
Usually, Wall Street has some sort of consensus, even if it's a loose one. But here, the divergence is massive.
Which means we have a lot of digging to do today. We're going to tear both of those narratives apart piece by piece. But before we get into the weeds, I do have to ask a small favor from you guys.
The price of admission.
Exactly. Consider this your ticket to today's deep dive. Please like the video, subscribe to our YouTube channel, and leave your feedback in the comments. We read every single one, and we base our upcoming research on what you tell us you want to hear. Seriously, it's mandatory if you want us to keep bringing you these insights.
And just to set the ground rules before we start throwing all these numbers around, what we're doing here today is a natural human debate. We're dissecting the sources, unpacking the data, and trying to find the actual signal in the noise.
Right.
But this is strictly educational, guys. We're analyzing public information, not giving you financial advice.
Absolutely. So let's get the 30,000-foot view here. Today is April 21, 2026. BigBear.ai closed at $3.79.
Ouch.
Yeah, and to put that in perspective for you, this thing is bleeding heavily from its 52-week high of $9.39.
Get a massive haircut.
More than half of its value, just gone. So our mission for this deep dive is to unpack the financials, the technicals, and the market sentiment to really understand the true story behind this defense AI stock.
Let's start by looking under the hood at the company's actual financial health, right? Because, well, you can't spot a value track without actually looking at the books.
Exactly.
And right now, Big Bear's financials are just a tale of two absolute extremes. I mean, if you only look at the balance sheet, you might think you struck gold.
Right. Let's unpack the good news first.
Yeah.
Because management keeps claiming they are officially in a rebuilding phase. And, I mean, the balance sheet does look pretty solid.
It does.
They are sitting on an absolute mountain of cash, like $462 million in cash and investments.
Which is huge for a company this size.
Right. And on top of that, they successfully wiped out 90% of their debt. They did this by converting $125 million in notes to equity. So as it stands today, total assets are at $894.5 million against only $282.7 million in liabilities.
Yeah.
If you stop reading the financial report right there, you're probably thinking, wow, this is a fortress. There's zero bankruptcy risk here.
Right. On the surface, yes. The cash pile and the debt reduction, it paints this picture of immense safety. But, the balance sheet is only a snapshot. It's just what you own versus what you owe on a given day. The real heartbeat of a company is the income statement. That tells you what they're actually doing with their time and their money. And that is where the reality check hits.
Oh, man, it is a brutal reality check.
Oh.
Because their full year 2025 revenue dropped 19.3% year over year.
Which is not what you want to see in AI.
No. They brought in $127.7 million, which is down significantly from the $158.2 million the year before. And the net loss, a staggering negative $293.9 million.
Yeah.
That equates to an earnings per share, EPS, of negative 82 cents.
And keep in mind that EPS is roughly flat compared to their loss in 2024. So, that means despite all this restructuring, they aren't actually improving their bottom line.
Right.
But if we dive into the mechanisms here, the truly terrifying number, the one that should give any investor serious pause, is the gross margin.
Oh, the margins completely collapsed in Q4 2025. They fell to just 20.3%, which is down from 37.4% year prior. And their operating cash flow is negative $41.9 million for the year.
And the outlook isn't better.
No, it says they're projected to stay cash flow negative until 2028.
Okay, let's unpack this. It sounds to me like someone who just inherited a massive trust fund, that's the $462 million in cash. But they are maxing out their credit cards every single month, on a failing side hustle.
That's a really good way to put it.
Right. I mean, does that cash pile actually matter if the core business revenue is shrinking by nearly 20%?
Well, it matters only in the sense that it buys them time. It delays the inevitable, but it does not fix the underlying business model. And, we really have to talk about why those margins are compressing so violently.
Yeah, why is it costing them so much? Well, in the AI sector, investors are conditioned to expect high growth and massive margins. You build a software platform once, right?
Yeah.
And you sell it a million times at an 80% or 90% margin.
Like a standard sauce company, you just scale it up.
Exactly. But BigBear.ai isn't just selling consumer apps. They are in defense AI. And defense AI is incredibly labor intensive.
Oh, right. Security and all that.
Yeah, you don't just hand a military contractor a generic AI model. You're dealing with highly classified, air-gapped servers.
Wow.
You have to custom code solutions to integrate with, like, legacy military hardware from the 1980s.
That sounds like a nightmare.
It is, and you need engineers with top secret security clearances to do it, and those engineers cost an absolute fortune.
Okay, so when you say gross margin dropped to 20.3%, that means for every dollar they bring in, it's costing them nearly 80 cents just to deliver the product.
Exactly.
They are spending a fortune on specialized labor just to keep the lights on, leaving almost nothing left over to cover their massive corporate overhead.
Yeah, and that is the core fundamental issue. Seeing a near 20% revenue contraction while gross margins get cut almost in half, it tells you that the actual machinery of the business is stalling out.
Wow. So we have a company bleeding cash operationally despite having this massive savings account. If the fundamentals are that chaotic, I guess the next logical step is to see how the market is physically pricing this contradiction today. Let's look at the technical analysis.
And the tape is painting a very clear, very heavy picture.
Heavy is the right word. The stock is trapped in a strict falling channel. For context, the 50-day moving average is sitting around $3.84, and the 200-day moving average is way up there at $5.71.
Yeah, that's a big gap.
Huge. And for anyone listening who might be new to charting, moving averages just smooth out the price data over a set number of days. When your short-term average, the 50 days, dragging almost $2 below your long-term average, that confirms you are in a massive, undeniable long-term downtrend.
Think of it like a boulder rolling down a hill, The stock has been heavy for a long time. Every time it tries to rally and catch its breath, sellers who are trapped at higher prices use that bounce as an opportunity to get out.
Which just pushes the price right back down.
Exactly. They're just trying to break even and escape.
Right. Now, in terms of levels, strong historical support sits right below where we are now, between $3.50 and $3.85. Support is basically the floor where buyers have historically stepped in, thinking the stock is finally cheap enough.
Right.
Immediate resistance, the ceiling is right above at $4.05. If bulls want to actually change the narrative and reverse this trend, they need a major high-volume breakout above the $4.35 to $4.50 zone.
But getting through that ceiling requires serious momentum, and this is where the technical indicators get incredibly muddy and, frankly, quite dangerous for retail traders.
I was going to say, I'm looking at these latest news indicators, and they seem completely contradictory. Like the 14-day RSI, the Relative Strength Index, is at 55.37. The RSI measures the speed and change of price movements. Typically, anything under 30 is considered oversold, and over 70 is overbought. So 55 is surprisingly neutral, maybe even slightly bullish.
Yeah, it looks okay on the surface.
Right. And then you have the MACD, which is sitting at 0.049. The MACD basically measures the relationship between two moving averages to show if a stock is accelerating. And right now, it's actually flashing a weak buy signal on some time frames.
It is flashing a buy signal, yeah, but you really have to zoom out. We also have to look at the order flow. Because this stock is highly volatile, we're seeing significant dark pool activity at these current levels.
And for the listener, just as a quick reminder, dark pools are private exchanges where massive institutions like pension funds or hedge funds trade large blocks of stock. They do this privately so they don't immediately spook the public market and crash the price before they finish their order.
Right. And when we look at the options market, the whale flow, which represents these million-dollar institutional bets, it shows a net negative premium of roughly $38,000.
Oh, wow.
Yeah, that indicates a slight but very persistent bearish pressure from the big money.
Wait, I have to stop you there because this is where people lose their shirts. How can the RSI be neutral to bullish and the MACD flash a literal buy signal while the institutional whale flow is negative and the stock is physically trapped in a falling channel?
It's a mess.
Are everyday retail traders just being lulled into a false sense of security by these technical buy signals?
Yes. I mean, this is the textbook anatomy of a value trap. It comes down to how mathematical algorithms interact with human psychology. Think of the RSI like a rubber band, right?
Got it.
When a stock falls violently from $9 down to $3, the rubber band is stretched to its absolute limit. Eventually, the aggressive selling exhausts itself. The stock stops going down for a few days, maybe it even ticks up 10 cents.
So the rubber band snaps back a little bit?
Yes, exactly. The RSI resets to a neutral 55, the short-term moving averages cross over, and the MACD spits out a buy signal. But those are micro signals happening inside a macro downtrend.
Ah, I see.
The fundamentals haven't changed. The institutions know this.
So it's a dead cat bounce.
Or a relief rally.
Right.
The computer indicators say, hey, short-term momentum is shifting up. But the whale flow, the institutions placing the actual million-dollar bets, they're looking at that slight bounce and saying, great, the price is up a few cents, let's use this liquidity to quietly offload our heavy bags, or buy more put options betting against it.
Oh, man.
A retail trader relying purely on a 14-day RSI might jump in thinking they caught the absolute bottom, completely blind to the fact that institutional money is quietly taking the other side of that trade.
That is fascinating and honestly terrifying. If we have this dangerous tug of war on the charts, we really need to look at who is actually buying and selling and what the professionals think this stock is genuinely worth. Let's follow the money into the sentiment and ratings.
Yeah, let's do it. Because the disconnect between Wall Street analysts and internal company reality here is staggering.
It's wild. The consensus Wall Street analyst rating right now is a moderate buy or a hold. The average price target is $5.33.
Which is way up there.
Yeah, the highest target out there is $6 and the lowest is $5. So even the single most pessimistic analyst on Wall Street has a target that is over a full dollar higher than the $3.79 the stock is currently trading at.
If you're just skimming headlines, that makes it look like a screaming bargain.
Right, but here's where it gets really interesting. Over the last 90 days, there has been net insider selling of roughly $387,000.
Yeah.
It's mostly from non-executive directors, but the real kicker is what is missing. There's been absolutely zero significant executive buying. Not a single C-suite executive is stepping up to buy shares at these so-called discount prices.
And that abscess is incredibly loud.
And then you add in the short interest. A massive 26.47% of the tradable float is sold short. For anyone unfamiliar, shorting means investors are literally borrowing shares to sell them, with the explicit hope of buying them back later at a lower price.
It's a direct bet that the stock will fall.
Exactly. So over a quarter of the market is actively betting on failure. Now, on the flip side, that also sets the stage for a potential short squeeze, right?
Oh, for sure.
If the company drops amazing news, all those short sellers have to scramble to buy shares to cover their positions, which can send the price into orbit. But still, the skepticism is deep. And when you look at fair valuation metrics based on their actual revenue declines, fundamental analysts say the fair value sits closer to $1.80.
It's a big drop from where we are.
Yeah. So I have to ask, if I'm a listener, how am I supposed to weigh a Wall Street analyst's shiny $5.33 target against the reality that the insiders running the company aren't buying a single share?
Well, honestly, I wouldn't trust the analyst targets here, and I'll explain why. Wall Street analyst price targets are very often lagging indicators. They're built on discounted cash flow models that require assumptions about future growth. And where do analysts get those growth assumptions? From the company management's own optimistic guidance.
Right, they're just feeding off the PR.
Exactly. Furthermore, career risk is a real thing on Wall Street. If an analyst drops their target from $6 to $2 overnight, they're essentially going on record admitting their previous research was completely wrong.
Ah, so they drag their feet, they lower the target by 50 cents every quarter so they don't look foolish.
Exactly. It's a slow, managed retreat. But insider activity, that is real money right now. There's an old saying in the market. Insiders might sell for a dozen different reasons. You know, they need to pay taxes, they're buying a yacht, they want to diversify their portfolio.
Sure.
But insiders generally only buy for one reason. They know the stock is going up. When a stock has been crushed from $9 to under $4, and fair value models are pointing to $1.80s, the absence of executive buying is a massive red flag. If the people who see the internal unaudited accounting every single day don't think $3.79 is a bargain, why should a retail investor?
That puts it in perfect perspective. So we have the fundamental bleeding, we have the bearish technicals acting like a ceiling, and we have this completely conflicted sentiment between lagging analysts and selling insiders. Now it's time to put all the cards on the table. Let's pit the best-case recovery scenario against the worst-case continuation lower. Let's settle the ultimate debate. Undervalued gem or retail value trap.
All right, let's lay out the bull case first. It absolutely exists, and it's built on a few very sturdy pillars.
Okay, the bull case. First up, BigBear.ai has a massive $400 million backlog. They are theoretically perfectly positioned to capitalize on defense AI spending, which is a sector getting flooded with government money right now.
Unprecedented amounts of money, yeah.
Right. Plus, they recently acquired a company called Ask Sage. This acquisition gives them direct, established access to highly lucrative NASA and U.S. Army contracts.
Which is huge.
The bulls argue that if Big Bear can execute on this $400 million backlog and start turning those contracts into actual recognized revenue on the income statement, watch out. Because that 26.47% short interest we just talked about?
Oh, it becomes rocket fuel.
Exactly. The shorts will panic, they'll be forced to buy to cover, and it could ignite a massive short squeeze.
I mean, it is the ultimate turnaround narrative. You have the government contracts, you're operating in the hottest sector on Earth with AI, and you have short sellers trapped in a very crowded trade. If management can just flip the switch, streamline their operations, and show profitability, the stock rips higher.
But then there is the bear case, and this is the value trap argument. The bears look at the company and see chronic revenue misses. And remember that brilliant move to reduce their debt by 90% that we talked about at the beginning.
The $125 million converted from notes to equity.
Right. Well, the bears point out that converting debt to equity wasn't free. It caused extreme share dilution.
Yes, and we really need to pause and explore the dilution aspect because it is the silent killer of retail portfolios. Think of the company's total market value as a pizza, right?
Okay, I like pizza.
When management decided to pay off that $125 million in debt, they didn't figure out a way to bake a bigger pizza. They just took the existing pizza, sliced it into twice as many pieces, and handed those new slices to their debt holders.
Right, so if I bought a slice last year, my slice literally just got cut in half.
Exactly.
And honestly, based on that 19% drop in revenue we talked about earlier, the pizza isn't just sliced thinner, it's actually shrinking in the oven.
That's a great way to put it. Dilution destroys shareholder value permanently unless the company can use that debt relief to hypercharge their growth. And so far, we just aren't seeing the growth.
On top of that, despite all these flashy government contracts, Big Bear is highly vulnerable to government spending cuts or even just bureaucratic delays in getting those contracts funded. The downside risks here are severe.
Extremely severe.
So what does this all mean? I look at the bull case, and a $400 million backlog sounds amazing on a press release. But if they keep missing revenue targets and their margins are down to 20% because of how labor-intensive this defense work is, are they just collecting government contracts they can't profitably fulfill?
That's the real fear.
Like, what good is a massive NASA contract if it costs you $1.20 for every dollar you make?
I think you've zeroed in on the exact mechanism of the value trap. In government contracting, especially in defense and aerospace, it is very easy to win a bid if you intentionally underprice your competitors.
Oh, wow.
Yeah, you get to blast out a PR statement saying, we won a $50 million deal with the Army. The market cheers, the algorithms buy the stock. But as we discussed, delivering on bespoke, highly secure AI systems is incredibly expensive.
Hence, the gross margins dropping from 37% down to 20%. They're winning the bids, but taking a bath on the execution.
Exactly. The bear argument is that BigBear.ai is essentially buying its revenue. They're stuffing their backlog with low margin or possibly even negative margin work just to keep the growth narrative alive for Wall Street.
Yikes.
If that's true, the $400 million backlog isn't an asset at all. It's actually a liability waiting to drain that $462 million pile of cash.
That paints a very dark picture for the fundamentals. Let's bring it all together. What is the outlook here for the listener? We need to separate the short-term noise from the long-term reality.
Right. Well, long-term, the one undeniable saving grace is the cash. That $462 million means they are not going bankrupt tomorrow. Even at their current operational cash burn rate, they have a runway to survive until roughly 2028.
Okay, so they have a buffer.
Yes. They have 2 years to try and fix the gross margin issues, integrate this Ask Sage acquisition, and prove they can actually be profitable.
But in the short term?
In the short term, the stock is fighting major technical and structural weakness. The trend is firmly down, institutional money flow is negative, and you have a massive block of short sellers actively suppressing the price. The burden of proof is entirely on the company right now. They can't
Yeah.
just coast on AI hype anymore. They have to show the math.
And they have to show the math very, very soon. The immediate catalyst for everything we've talked about today is the Q1 2026 earnings release. It's coming up in just a couple of weeks on May 5, 2026.
That's the big one.
That report is going to be the crucible.
Yeah.
It will either prove the bulls right, that the backlog is finally converting to profitable high-margin revenue, or it will prove the bears right, that the core business is still shrinking and the cash pile is just delaying the inevitable.
Mark your calendars for May 5th because it is going to be highly volatile. Given the 26% short interest, any surprise to the upside, any sign of margin improvement could cause a violent upward spike.
Right, the short squeeze.
But if they miss revenue again, or if those margins drop below 20%, that strong historical support level at $3.50 might completely cave in, sending the stock tumbling toward that $1.80 fair value estimate.
Which brings us right back to where we started. You look at BigBear.ai today. They have a massive cash runway. They have the high-profile government contracts with the Army and NASA, and they are operating in the hottest, most well-funded sector on the planet right now, artificial intelligence.
Yeah.
And yet, the revenue is shrinking, the margins are collapsing, and the people running the company are actively selling their shares instead of buying them.
It is the ultimate diagnostic puzzle.
It really is. So I want to leave you, the listener, with this one thought to ponder as we wrap up today. If the company has all this cash and all this world-class AI tech, but the executives aren't buying a single share at these depressed prices, what do the insiders know about that upcoming May 5th earnings report that we don't?
That is the million-dollar question.
Let us know what you think. Are you buying the dip, hoping for a massive short squeeze? Or are you staying far, far away from this value trap? Drop your thoughts in the comments below. And please, if you enjoyed this deep dive, don't forget to like the video and subscribe to our YouTube channel so you never miss an update. We will see you on the next one.